You do this every day. You tap your phone or card to pay for coffee, buy groceries, or fill up your car. You don't think twice. Your money feels instant, digital, convenient, and yours. But what if it wasn't? What if a transaction was suddenly denied, not for lack of funds, but because a central algorithm decided it wasn't appropriate? What if the digital dollars in your account had an expiration date, a use-by stamp counting down to zero? This isn't a scene from a dystopian movie. This is the potential reality of central bank digital currencies, or CBDCs. A silent financial revolution is underway, led not by rebels, but by the world's most powerful central banks. They're building a new form of money that could fundamentally redefine your wealth, your privacy, and your financial freedom forever. This is the story of the biggest transformation to money in a century, and it's happening right now, largely behind closed doors. To understand what's at stake, we need to pull back the curtain. If you want to stay ahead of the curve on the technologies shaping our world, make sure you subscribe, because this is a topic you can't afford to ignore. Let's start with the most basic question. What exactly is a central bank digital currency? On the surface, the definition seems simple. A CBDC is a digital form of a country's official currency. A digital dollar, a digital euro, a digital yen. Crucially, it's a direct liability of the nation's central bank. Think of it like putting physical cash onto your phone, where each digital token is a direct claim on the government, just like paper notes and metal coins. While it's not always a given, many are designed to be legal tender, meaning it could be required to be accepted for all debts. This makes it fundamentally different from every other form of digital money you use today. And to truly grasp the scale of this change, we need to be very clear about what a CBDC is not. First, a CBDC is not the money in your commercial bank account. When you see a balance in your Chase or HSBC app, you're not looking at government money. You're looking at a commercial bank's liability, a promise from that private institution to pay you. That money is an IOU from the bank. If that bank fails, your deposits are only protected up to a certain insured limit. A retail CBDC, on the other hand, would be a direct claim on the central bank. It would be the digital equivalent of holding physical cash, considered the safest form of money in an economy because it carries no private bank credit risk. Second, a CBDC is not PayPal, Venmo, or Apple Pay. Those are payment services, layers of technology that sit on top of the existing banking system. They are incredibly efficient messengers, moving instructions to transfer money from one commercial bank account to another. They aren't creating a new type of money. They're just creating a slicker way to use the old money. A CBDC isn't a new app. It's a new foundational asset. It's like the difference between building a faster mail truck and inventing email. One improves the old system, the other replaces its core mechanics. And third, most importantly, a CBDC is absolutely not a cryptocurrency like Bitcoin. This is the biggest point of confusion, and the distinction is critical. Cryptocurrencies are defined by their decentralization. They operate on a distributed network of computers with no single entity in charge. A CBDC is the exact opposite. It is the definition of centralization, issued and completely controlled by a single authority, the central bank. Their values are also fundamentally different. Bitcoin's price is notoriously volatile, driven by supply, demand, and market speculation. A CBDC is designed for stability. Its value is permanently pegged to the nation's fiat currency. One digital dollar will always be worth $1. Furthermore, cryptocurrencies like Bitcoin offer a degree of pseudonymity, resisting centralized control. CBDCs, by their very nature, are designed to give authorities regulatory oversight and traceability. The two concepts are philosophical polar opposites. One is a push for stateless, decentralized money, while the other is the ultimate evolution of state-controlled currency. So that brings us to the next logical question. If we already have digital payments, and this isn't crypto, why are governments and central banks around the world suddenly in a mad dash to create this new form of money? What problem are they trying to solve? According to them, quite a few. The official narrative presents a kind of utopian vision for the future of finance. First and foremost is the argument for payment efficiency. Today, especially for cross-border payments, our financial system is often slow, clunky, and expensive. Sending money internationally can take days and involve a web of intermediary banks, each taking a cut. CBDCs, proponents argue, could enable near instantaneous settlements, 24/7, at a fraction of the cost, though this depends heavily on the final design. Then there's the goal of financial inclusion. Billions of people around the world remain unbanked, without access to basic financial services. A CBDC could, in theory, allow anyone with a basic mobile phone to have a secure digital wallet, bringing them into the formal economy without needing a traditional bank account. Central banks also argue that CBDCs are a powerful tool to combat illicit financial activity. Since transactions would be on a government-accessible ledger, it would become vastly more difficult to engage in money laundering, terrorism financing, or tax evasion. The anonymity of large cash transactions would simply vanish. And finally, there's a defensive motivation: the rise of private digital currencies. The prospect of a company like Meta launching a global stablecoin was a massive wake-up call for governments. They realized that if they didn't offer a public digital currency, they could lose control of their own monetary systems. As physical cash usage plummets, central banks see CBDCs as a way to ensure the public continues to have access to safe, state-guaranteed money. This all sounds reasonable, even beneficial on the surface. But how would it actually work? There are a few models being discussed, but most are converging on a similar structure. The most radical idea is a direct model, where every citizen would open an account directly with the central bank. This is largely seen as impractical due to the massive operational burden it would place on the central bank. The far more likely approach is a two-tier or hybrid model. In this system, the central bank would issue the CBDC and maintain the core ledger. However, private companies, like your existing bank or even tech companies, would manage the user-facing wallets and services. They would handle customer onboarding, identity verification, and build the apps you'd actually use. But even here, the fundamental change is profound. The money in your wallet would still be a direct liability of the central bank. Your commercial bank would simply be a service provider, a custodian for your wallet, rather than the holder of your deposits. This could dramatically change the role of banks, whose business model relies on taking deposits and lending them out, if large amounts of money migrate from bank accounts into CBDC wallets. And it's here, at the intersection of technology, money, and power, that the quiet revolution starts to reveal its more concerning implications. We've heard the official story of efficiency, inclusion, and safety. But this is where the narrative takes a sharp turn. This is where the quiet revolution stops sounding like a simple system upgrade and starts looking like a re-engineering of your relationship with money and freedom. What are the risks they aren't advertising? The single most consequential feature of a CBDC is the potential for programmability. This is the ability to embed rules directly into the money itself. It transforms money from a passive tool for exchange into an active instrument of policy. Now, many central banks in the West stress they want to avoid excessive control, but it's important to understand what is technically possible. Imagine a government issuing stimulus payments. With a CBDC, those funds could be programmed to expire, forcing you to spend them quickly. During pilot programs in China, some giveaway funds reportedly came with time limits, similar to a voucher. Money could also be programmed for specific uses, like restricting welfare benefits to be spent only on approved items like food and housing. This programmability opens the door to unprecedented social engineering. It's technically feasible that a government could program the currency to make fuel purchases more expensive or even block them after a certain limit. While this level of control is not a stated goal in most Western CBDC proposals, the very possibility is a central part of the debate. The power to make those choices would rest with the central authority. This leads us to the second major risk, the erosion of privacy. Cash is anonymous. A CBDC is the opposite. By design, every transaction could be recorded on a central ledger, potentially visible to the issuing authority. This would provide the state with a granular, real-time map of financial interactions. That centralized data would also become a prime target for hackers, creating an enormous national security risk. Combine this surveillance with programmability, and you arrive at a tool for potential financial censorship. In a world with CBDCs, critics warn that authorities could freeze or seize the funds of protesters or dissidents with the click of a button. While most central banks are designing with rule of law constraints in mind, the potential for misuse in the wrong hands is what worries human rights advocates. This is the heart of the trade-off, a future of convenience offered at the potential cost of financial autonomy and privacy. It's easy to dismiss this as a far-off fantasy, but this isn't a theory. It's happening right now at a breathtaking pace. As of late 2025, around 134 countries, representing over 98% of global GDP, are actively exploring, developing, or have already launched a CBDC. This is a global, synchronized movement. Nowhere is this more advanced than in China. The digital yuan, or ECNY, is in a massive pilot phase that some might say is beyond a simple test. It's a functioning reality for a growing number of users, with transaction volumes in the trillions of yuan. The Chinese government has promoted its use in retail, transport, and for government payments, and has even experimented with time-limited funds in some pilots. But China's ambition isn't just domestic. It is promoting the ECNY for international trade, positioning it as an alternative to the US dollar. This push has forced a reaction from the West. The European Central Bank is deep into its digital euro project, with officials suggesting a potential issuance around 2029. Their stated goals are to ensure Europe's strategic autonomy in payments and compete with non-European tech giants. The United States has been more cautious, but the Federal Reserve is now participating in cross-border CBDC research. Policymakers recognize that failing to act could risk the US dollar's status as the world's primary reserve currency. And it's not just the major powers. Countries like the Bahamas with its sand dollar, Jamaica with its Jamdex, Nigeria with its e-Naira, and Zimbabwe with its gold-backed digital token have already launched CBDCs, though adoption has been low in some cases. India is running a large-scale pilot for its digital rupee, and Brazil is developing its Drex. The race is on, and every major economy is on the field. This global race isn't just about tech leadership. It's the dawn of a new era of economic statecraft and a redrawing of the global financial map. One of the most immediate applications is in international sanctions. With CBDCs, sanctions could become brutally precise, targeting specific individuals or companies and surgically blocking their ability to transact. This is giving rise to new digital currency blocks. The most prominent example is Project mBridge, a collaborative platform involving China, Hong Kong, Thailand, the UAE, and now Saudi Arabia. It is designed for cross-border payments between these nations using CBDCs, and it works outside of the current Western-dominated SWIFT messaging system. While its official goal is efficiency, many analysts see it as a direct technological challenge to the US dollar's dominance. This creates a powerful defensive imperative for the United States. Exploring a digital dollar isn't just about modernizing payments. It's a move to protect the dollar's global reserve status. If the rest of the world builds efficient, non-dollar payment rails, global demand for the US dollar could decline, undermining America's economic and political influence. And at the heart of this new great game is data. Whoever controls the CBDC platform controls the data on all transactions that flow through it. For the first time, nations could have perfect visibility into vast corridors of international trade, granting them an unprecedented intelligence advantage. Data is the new oil, and CBDCs are the pipelines. So where does this all lead? The first potential casualty is physical cash. While central banks publicly state that CBDCs are meant to complement cash, many worry about a de facto end of cash, where it's legally available but practically unusable as society moves on. The next great challenge will be interoperability. Will these emerging digital currency blocks be able to talk to each other, creating a seamless global network? Or will we enter an era of financial fragmentation, a splinter net of money, where digital currency zones operate in walled-off ecosystems? This transformation goes far beyond finance. It has the potential to reshape international relations, trade alliances, and the balance of global power. This isn't just a fintech story. It's a story about the future of society, power, and individual liberty. We stand at a historic crossroads. One path leads to a future of unparalleled financial efficiency, a world of instant, cheap, and inclusive payments. The other path could lead to a world of unprecedented surveillance and control, where our money is no longer a neutral tool, but a programmable instrument of the state, and our financial privacy is a relic. This is the stark choice presented by the quiet revolution of central bank digital currencies. The promise of convenience versus the peril of control. This revolution has been happening silently, but its consequences will be loud and will affect every single one of us. That's why it's more important than ever to stay informed. So I have to ask you, is this the future of money you want? What is the one feature of a CBDC that excites you the most? And what is the one that worries you the most? Let me know your thoughts in the comments below. Thanks for watching, and if you found this video valuable, consider subscribing to stay ahead of the curve on the technologies that are rewriting our world.